Black Monday, anatomy of the 1987 crash. Let's get right into this explainer. 1.71 trillion US dollars. Just let that number sink in for a second. That is the staggering, unimaginable amount of worldwide financial wealth that was literally wiped out in a single day on October 19, 1987. It was an event so incredibly severe, it instantly sparked global panics that we were heading straight into a completely new Great Depression. But how did it actually happen? Like, what caused the absolute worst single-day drop in stock market history? Well, today we're going to perform a forensic autopsy on this financial disaster. We'll look directly at the data to figure out exactly what broke, why the contagion spread worldwide like wildfire, and how it completely rewired the modern financial system. Section 1. The Black Monday Crash. You really have to look at the sheer, unprecedented scale of the destruction on Wall Street to grasp this. The Dow Jones Industrial Average plunged a record 22.6% in a single trading session. That's 508 points gone. The S&P 500 dropped over 20%, and the Wilshire 5000 fell 18%. And the craziest part? The sheer volume of sell orders was so massive that Wall Street's computer and communication systems were completely overwhelmed. I'm talking trades left unfilled for over an hour because the tech literally could not keep up. Now, this collapse didn't just happen out of nowhere. We were actually riding high on a roaring 5-year bull market that started back in August 1982. It had basically tripled the S&P 500. But the week before the crash, the whole mood just shifted. On Wednesday, October 14th, news of unexpectedly high U.S. trade deficits and a new tax bill targeting corporate takeovers hit the market. By Friday the 16th, the Dow was already down 4.6%. Selling pressure was building up over that weekend like steam in a pressure cooker. And that brings us to the underlying psychology of the whole thing. Economist Martin Feldstein really hit the nail on the head when he noted the market was in a massive speculative bubble. Prices were rising way faster than corporate profits could actually support. Look, everyone fundamentally knew stocks were overvalued, but investors were greedy. Nobody wanted to miss out on the rally. They were highly leveraged, and frankly, they were very, very nervous. It was a completely fragile environment, just waiting for a spark. Section 2. Anatomy of a Meltdown. So what was the spark? Well, first we have the macroeconomic triggers. There was a major crisis of confidence surrounding the US dollar and something called the Louvre Accord, which was basically an agreement meant to stabilize international currencies. When the West German Bundesbank moved to raise short-term interest rates, the US Treasury Secretary at the time, James Baker, publicly clashed with them. This public spat absolutely panicked international investors. It raised this terrifying prospect of a currency war or a total collapse of the dollar, which suddenly made U.S. stocks look incredibly unattractive. But the really crucial point here is how the market reacted to all that fear. And that leads us to this fascinating and ultimately disastrous piece of 1980s financial engineering called portfolio insurance. This was a hedging strategy that relied heavily on computer models. And the kicker? Instead of looking at real-world news or market fundamentals, these computers were programmed to execute informationless trades, meaning if the market price dropped, the computer automatically sold index futures to limit losses. Zero human context. And you can probably guess what happened next. These automated systems triggered a devastating financial doom loop. Step 1. Because of that weekend panic we talked about, the stock market opens way lower on Monday. Actually, some stocks were so overwhelmed with sell orders they didn't even open on time, leaving their listed prices stale and artificially high. Step 2. The futures market opens on time and tanks immediately. The portfolio insurance computers see this drop and instantly trigger massive automated sell orders. Step 3. Index arbitrage traders spot the huge price gap between the dropping futures and the stalled stock prices, so they jump in, heavily selling stocks to exploit that gap. Step 4. This intense selling drives real prices even lower, which, yep, you guessed it, triggers the computers to sell even more. It was a total, unstoppable, mechanical downward spiral. But it wasn't just the machines going haywire. Human psychology amplified the crash through what economists call noise trading. Imagine being an investor in this highly volatile, totally confusing environment where computer screens are lagging for an hour. Terrified people started trading on rumors, the noise, as if they were cold, hard facts. They were wild, false rumors spreading that the New York Stock Exchange was going to close, and rumors about massive clearinghouse insolvencies. It created this self-reinforcing contagion of fear worldwide. Section 3. The Liquidity Crisis. So Monday was a historic bloodbath. But Tuesday's terror was the actual hidden threat. Margin calls, which are basically demands for investors and firms to put up more cash to cover their trading losses, spiked to 10 times their average size. The terrifying reality was that several clearinghouses and brokerages simply didn't have the cash on hand. If they failed to pay, it could have triggered a catastrophic domino effect, sweeping over the entire financial system and absolutely devastating the real day-to-day economy. Enter the Federal Reserve. They had to act as the ultimate lender of last resort, and their crisis management was massive and immediate. On Tuesday morning, newly appointed Fed Chairman Alan Greenspan issued a highly decisive statement. By midday, the Fed had injected $17 billion into the banking system through open market operations. To put that into perspective, that was more than 25% of all bank reserve balances at the time. This massive flood of liquidity rapidly pushed the federal funds rate down by 0.5%. And here is Alan Greenspan's exact terse statement. That brevity, totally deliberate. It was designed to calm the markets without giving anyone room to misinterpret it. The Fed then paired this massive public liquidity injection with moral suasion. Basically, they aggressively pressured nervous, hoarding banks in New York and Chicago to keep lending to struggling securities firms. They essentially strong-armed the banks into saving the brokerages from immediate insolvency, stopping the whole system from shutting down.
Section 4. The Global Contagion.
Now, this wasn't just an American problem. The market carnage behaved like a virus, leaping across international time zones, though it varied significantly depending on where you were. While the United States dropped 22.6%, Hong Kong plummeted a staggering 45.8%. On the milder end, Austria only saw an 11.4% decline. But ultimately, out of 23 major industrialized countries, 19 of them suffered drops greater than 20%. Hong Kong's market was hit so hard it actually seized up entirely. Their futures exchange suffered a catastrophic systemic failure. Why? Well, they had incredibly lax credit controls. It was a freewheeling environment where margin requirements were just routinely ignored, and the retail base was largely inexperienced and driven mostly by pure speculation. On top of that, their guarantee corporation was severely underfunded, holding only $2 million to back thousands of defaults. It literally forced a 4-day shutdown of the entire market and required a massive multi-billion-dollar government bailout just to preserve public order. It's wild to see how different government reactions dictated the economic survival of these countries. In Japan, during what they called Blue Tuesday, the Ministry of Finance exerted their own moral suasion. They literally invited top brokers to tea to encourage buying. Thanks to that and some strict trading curbs, Japan recovered all its losses in just 5 months. Conversely, look at New Zealand. Their reserve bank strictly refused to loosen monetary policy to fight inflation. Without that crucial liquidity, New Zealand plunged into a massive deleveraging crisis in a brutal 6-year recession. Section 5. Aftermath and Market Legacy. So, what actually changed after all the dust settled? Well, the long-term economic shifts were profound. First, the Louvre Accord was functionally dead. Governments finally realized that international currency coordination via target zones just wasn't possible against global market forces. Second, we saw the emergence of the volatility smile in options pricing, which was a permanent mathematical shift in how risk is calculated in American markets. And third, regulators executed a total top-to-bottom overhaul of trade clearing protocols to handle high-volume stress. But the absolutely most crucial legacy of the crash was the creation of market safety nets. Pre-1987, there was nothing catching you. Automated selling loops can just run away into the abyss. Post-1987, exchanges implemented trading curbs, which we all know today as circuit breakers. If a market experiences an exceptionally large price decline, trading is temporarily halted. It literally forces a pause to give humans time to assess the data, effectively breaking the panic loop. In fact, these exact circuit breakers successfully prevented a total meltdown decades later during the 2020 stock market crash. Which brings us to a critical final thought for you to consider. The 1987 crash was driven by primitive computers trading over minutes and hours. With today's hyper-sophisticated AI and algorithms executing massive trades in mere microseconds, are our modern circuit breakers truly strong enough to stop the next Black Monday? Think about that. Thanks for joining me on this explainer, and as always, keep questioning the data.